Hey, welcome to podcast number 199. Yeah, we'll be having our 200th episode next time. And actually, there was podcasts before these 200, or these 199, but this was the new format started about 3.5 years ago. So on a pretty good pace to try to get you a lot of information. Well, the stock market celebrated today with a big jump up, and it was obvious that a lot of people had bailed out of the market and then had to retrace their steps. And you can see from the S&P 500, which finished up on the day, by the way, 36 points, over 2%. All the major indices were up over 2%. The Dow Jones had a plus 300-point day. And it was also, the important thing about today is the intensity of the rally and the breadth, and we'll get into that in just a minute. But you can see here, I mean, this bar here gets us back, pretty much erased all of 5 days of losses. So it was an important day from that standpoint. The other thing that it did, and we talked about this in prior podcasts, is is this going to turn out looking just like every other pullback this year? And we've had three, I don't even call them major, but the biggest pullbacks have been off of this 100-day moving average, which, again, the 100-day moving average is not one that a lot of people talk about. They usually talk about the 50 or the 200. I'm not somebody that looks at the 100 all the time. It's just what you're trying to find are patterns. And this so happens on the S&P 500, the pattern is that the market drops down to and a little below the 100-day moving average and then bounces off of it. There's always been a reason each time where you thought maybe it wouldn't that particular time. And this was no different. This may have been this year. The biggest reason it wouldn't is because of all the shenanigans going on in Washington. And, it's been my thought along the way here that, they've been playing a game of chicken. They know that they're not going to default. At least I didn't think they were going to default and still don't. But they have this deadline coming up, which, again, was the 17th of October, which is a week from today. However, there's more money there that the deadline is actually a little past the 17th. But here's the deal. The Republicans were really fighting for Obamacare. That's kind of a non-starter. It looks like that ain't going to happen. And so now they're kind of backing in a little bit, and there's some talks happening. So that's what's going on, and you already know that. You might know a lot more than I do about that. But what we're looking at here is this kind of channel, and we got to the bottom of it. And the important thing, though, about today was not necessarily just the fact that it reversed those last few days. It was that we had, almost a 90% down day. I think it was 2 days ago. Pretty intense selling. It wasn't quite a 90%, but it was one of those days where almost everything was down. The VIX was very high, a lot of fear. That's typically you get a few of those, 2 or 3, and then you get a intraday reversal, and then you get this big, strong, buy, and that's how you know it's a bottom. And we kind of had something that wasn't maybe perfect, but it kind of lined up that way. You had this 90%, almost 90% down day. It went lower yesterday, but got it back, so it made an intraday reversal, not on huge volume or anything. And then today you're followed up with a clear 90% down day that was just very, very strong, across the board. I mean, you're talking about biotech, which had been the worst performer of all the sectors, was the leader today. Aerospace and defense up. Oil and gas up, financials up, and we're talking 2 to 3% here. Russell 2000, you name it, it was up across the board. The only thing that was down was gold, and even treasuries, by the way, rallied on the day, which was kind of interesting because if you take a look at TLT, which is the treasuries ETF, look what it did. It had a big jump in the middle of the day. Now, some would have thought, okay, well, these should be selling off because money's going to come out of those safer instruments and into the stock market. But remember, here's what happened the last few days. There was a battle, and I talked about it, and I wasn't able to illustrate it, so I drew arrows going either direction. But you had a battle going on where people were going in there buying treasuries because they were scared, and when they're scared, they abandon stocks and they buy treasuries, right? But they were scared that they wouldn't get paid back on government instruments, and so they started selling. And so you had this kind of battle going on. And so when it looked like the talks may happen and that there may be some kind of deal in the works, treasuries started going up. And so actually bondholders didn't make a lot, but they made some today, and stockholders made money. So across the board, it was a very strong day overall. Now let's take a look at the volatility index. This was something that we had looked at the last few days and had been pretty predictable this year, as far as not necessarily the absolute level, but the pattern it had been in. It just zigzagged back and forth. So at some level, it wasn't going to keep doing this, but it would turn around and ease up. And we said, look, the way to make money in this, and this is an indicator that I'd come up with several years ago, not this particular what you're looking at, this is just the VIX, but I have an indicator that I look at that I created. And what I look at is really the intensity of these moves and how fast the fear is escalating. And what we want to see is the fear abate a little bit before we buy. And it has. It's in the zone that gives you the all clear. Now, if you're somebody that is sitting there with, a lot of cash, you should be buying some right now, because this big reversal we had, where we had this huge downdraft the last few days, and then we come back with a very strong broad rally today, that's the sign you're looking for. If you're somebody that's 85 or 90% invested, buying on a day where it's up 323 is probably not wise. Probably give some back a little bit. But as I mentioned in the last few podcasts, I haven't been making a lot of moves at all throughout this whole ordeal. And that's tough at times, but it's very satisfying on a day like today too, because you don't get whipsawed. The chance of whipsaw risk, and that's buying high, selling low, buying high, is very high. How many people the last few days bought and sold the S&P, or, got to the point where they said, okay, I'm out? Remember I talked about pain thresholds last time and said, what is your pain threshold? And if your pain threshold was here, then fine, you can sell. But if your pain threshold's down here, you shouldn't be selling. In fact, if you have some cash, you should be buying. And we should get to a point where the fear picks up enough to where we're going to get a snapback. And that's what happened. Now, if you look at the Dow Jones, the Dow Jones actually broke its trend line, so that could have triggered some selling for some people, but it had a safety net, right? It had the 200-day moving average, which it bounced off of, and it clearly has broken this little downtrend. I mean, it had been making lower highs, and it's broken that. So now I think what you want to see, and what would be constructive besides just a runaway, is some type of little bit of, down, maybe give back a quarter of the gains from on lower volume. And then you can start another leg up and start to zigzag higher, as we've been doing back here. Because that's been the pattern each time, is we've come down, come up, come down, come down, come up, come down, and now we bounce. So, and the things, obviously, like I said, I wrote an article yesterday about all the things that have been getting crushed, the Netflix of the world the last few days. And those things did really well today. Netflix was up 5.39%, did give back some of it, but, it bounced right off its 50-day moving average. You got companies like Groupon, and I'm not suggesting these are buys. A lot of these are companies that I've really struggle with and wouldn't buy, because the financials aren't very clear and are bad in some cases. But they're very cultish momentum stocks, and they had been working up until the last few days. Pandora, which obviously is going to be competing directly with Apple, getting hurt badly. Yahoo, having a big downdraft yesterday and reversed, came back today up 2.6%. Priceline up 2.4%. Facebook up about 5% today. So these were things that, I'd said if those are the kind of companies you want to buy, then get ready, because they may bounce. And and they were getting hit, and that's why we called the article Momo Nomo, which it was a question mark, saying basically, is it the end of these momentum stocks? And it certainly was, until the point where it hit the 50-day moving average on a lot of them. And of course, they're going to go up when the market goes up. So continue to watch those, because those have been leaders. And if you start to see them lag, that tells you that it's going across the board. But again, how many people have been selling out the last few days only to see them sitting in cash and the market run away without them? So be careful of whipsaw, because again, it's still very news driven, and that's not going to change over the next few days. But certainly, if you turned off the TV and you were just watching the market, and you saw a big downdraft the last few days, and then you saw this intraday reversal yesterday. Let me change this to the SPY so we can see some volume on here. But you had pretty decent volume yesterday, and then you had even bigger volume today. That's you look for. That's what a bottom looks for. And when I say bottom, I don't mean a bottom for the next 6 months to a year. I'm just saying you're looking for a tradable bottom if that's what you're into. What we need to see if you're investing is there continuation over the next few days? Is there follow through, or does it continue to fade? And certainly if the data continues to get better, of course we haven't had a lot of data, right, because it's not getting released. But if the data does get better, and we're in earnings season obviously, and earnings are start reporting, then there's no reason why we won't take out the old highs and head higher into the end of the year. All right, guys, that's all I have for today. Just wanted to update you that basically no moves have been good moves the last few days. If you could time it perfectly, then congratulations, because that is not easy given what's going on. Some things were definitely stretched, but it's still scary when you see these yahoos on TV. And basically a day like today, if you didn't make any moves, you got back, any of the fear for the last 3 or 4 days. So let's see if this can build on itself. But like I said, this was the makings of what you want to see for a continuation. Don't forget, before we go, early in the year, remember what happened January 1st. January 1st, right over here, you had the fiscal cliff, right? Which is why we're having a lot of the problems we still have, is because it was kick the can down the road day, which probably what it's going to be here. But remember, you had 2 strong days right out of the gate after a fall. See, you had the little fall just like we're having now, 2 strong days, and you never got a chance to get in. Could that happen now? It's a distinct possibility that happens. So watch it. I mean, again, if we have 2 strong days, don't think that, it's running away from me and it's got to come back. Sometimes it doesn't. So that's why I talk about these 90% up days, because they're very important, because it shows a lot of commitment, and it shows you got a lot of breath out there right now. So don't forget, hey, we're on Facebook, Twitter, Google+. We're on iTunes and EggersCapital.com. All right, guys, have a great evening.